Stocks appear to be rallying on the expectation of a Trump win, but prospects of a rising deficit under his leadership seem to be spooking the bond market. 10-year Treasury yield hitting its highest level since July 5th in today's session before pulling back. For more on what the markets are telling us, let's bring in Wells Fargo Securities Global Head of Macro Strategy, Michael Schumacher. Michael, great to see you. You're joking that the last time you were here, the 10-year yield was 60 basis points lower, and I think that was just in September. What is the bond market telling us at this point?
Bond market's telling me I better stay away in December, that's for sure. We don't want to risk another 50. But to me, that the bond market's pricing the Trump trade pretty clearly. I'll give you an example. I was in Asia last week. We saw countless investors across a number of countries. And I would say 90% of the questions I got were about Trump. What would Trump do? Would you really spend this amount of money? What about the tariffs? And I kept thinking the race is 55-45, 60-40. It's very, very close. And yet people were very skewed toward Trump already winning. So I think they priced in a lot of that. So it seems to me that if Harris does win, yields come down pretty substantially.
You have some legendary people. Paul Tudor Jones last week on Squawk Box. I want to say Stan Druckenmiller the week before. Stan's now 20% of his portfolio short bonds. Paul Tudor Jones said similar. They obviously have a view on rates going higher. What are your thoughts on that?
Maybe just a little bit higher. It's tough for me to see yields going substantially higher at this point. I think you really need a huge spending plan out of Trump. So Trump to win, Republican sweep. If Trump really talks up another percentage point or two in the deficit, maybe that kind of thing would really spook the markets. But they've run so much already. Pricing for the Fed has gone up by, 70 basis points, I think, in terms of terminal rate. It's pretty spooky. I can't see a heck of a lot more from there.
You heard Steve talk about the possibility of us not knowing who controls the House and potentially who controls Congress, maybe even the actual presidential election until the end of November, because California is such a slow vote counting state. In that scenario, what sort of volatility should investors be bracing for? And are investors actually positioning for that sort of heightened, prolonged volatility?
I think investors are not positioned for heightened volatility.
Should they be, in your view?
They should be. They should be taking down some risk right now, or maybe adding some volatility protection, Melissa. When you think about it, it's comparatively cheap in some markets. Foreign exchange, equities, not too bad. Interest rates a bit higher. But we could see an instance in which it's not clear who the next president is for a week or two. In the House, who knows, 3-4 weeks, according to Steve. Senate, perhaps a while as well. People just aren't geared toward that. They seem to think we'll wake up November 6th, maybe the 7th, and it's all clear. I think that's very unlikely.
What do you make of the idea? You guys covered the fundamentals of the trade. What do you make of the idea of price triggers with CTA accounts, where you get to a certain level and people have to reverse whatever trade that they put on? I'm hearing that was a big aspect of it, not the full aspect of it, but another aspect.
Could be some of that, but it's interesting how much of that is still to go and how much is played out. I would argue that 60-odd basis points move in the 10-year in the span of about a month. That's a pretty full move. So it seems to me it's unlikely we'll see more of that technical type of flow. It's going to be more fundamental from here. At least that's my thought.
Overall, though, what is your overarching view to year end? We might have a few weeks of volatility, but we end the year, what, higher than here?
It's so conditional on the election.
Okay.
So if it's a sweep, I'd say yields go up a bit and then gradually start to come down. If it is Harris winning, it's divided government, you probably get much more of a sharp move down quickly and yields find a home. So my general bias is post-election yields drop, but the road between now and then is so rough, you can't really make a year-end call in my view. It's got to be if this happens in the election, then X in the bond market.